We're jumping straight into Mobix Labs today. Everyone is watching the price action, but the real story is they're accelerating production orders in the defense and aerospace sectors.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Subscribe and hit the like button.
Yeah.
Because today we have a pretty complex situation on our hands.
We really do.
And for those of you who have just been tracking the massive volume spikes lately and wondering what is actually happening beneath the surface, well, we need to set the stage first.
Right. Context is everything here.
Exactly. So this is a semiconductor company, but they do not operate massive manufacturing plants with, giant clean rooms and multi-billion-dollar fabrication lines.
No, they operate on what the industry calls a fabless model.
Right. Their core focus is designing advanced wireless connectivity, radio frequency technology, and highly specialized EMI filtering.
And these components are built specifically for high-reliability markets. We are talking about the commercial 5G rollout, but more prominently, the military and aerospace sectors.
Which is the only way to make sense of the explosive market reaction we saw in early March 2026.
Yeah. Anyone tracking the information technology sector noticed their shares experiencing this massive surge in trading volume.
Mm-hmm.
They became a top mover across multiple consecutive trading sessions. And the catalyst for that volume deviation wasn't retail momentum.
Or just random market noise, yeah.
Exactly. It was tied directly to hard fundamental news. They received new production purchase orders for their components to be integrated into Gulfstream aircraft.
And what the broader market immediately recognized is that these follow-on procurement orders are tied to ongoing long-term manufacturing schedules.
Right. Which indicates accelerating demand rather than just a one-off prototyping experiment.
Which brings up an interesting paradox that kind of serves as the foundation for the bull case here. When you look at the corporate structure of Mobix Labs, the very first thing that jumps out is their headcount.
It's small. Very small.
They only have about 50 employees. For a company securing component placement in premium mission-critical aircraft, that sounds exceptionally small. I mean, how does a 50-person operation manage that level of output?
It comes down to the mechanics of that fabless model we mentioned.
Right.
To put it in perspective for you analyzing their fundamentals, fabless means they focus entirely on the intellectual property.
They design the cutting-edge chips and engineer the proprietary radio frequency technology.
And then they completely outsource the physical manufacturing of the silicon to a third-party foundry.
Because building a modern semiconductor fabrication plant costs tens of billions of dollars.
Tens of billions, yeah. And it comes with astronomical ongoing overhead, maintenance, and utility costs.
Mm-hmm.
By keeping the team lean at 50 employees and letting a dedicated foundry handle the heavy machinery, their operating expenses stay remarkably low.
That structural advantage seems crucial for their cash flow.
Oh, absolutely.
The revenue they generate isn't being consumed by the operational bloat of running a physical plant. They can theoretically redirect that capital much more efficiently.
That is the core financial thesis here. It allows their free cash flow to be pumped aggressively back into targeted growth initiatives.
Right.
Right now, instead of managing massive facility payrolls, they are taking that capital and reinvesting it into transitioning to new, larger, military-approved facilities.
So they are actively expanding their defense manufacturing footprint and their testing capabilities.
Without dragging around the financial anchor of a traditional, vertically integrated corporate structure.
But what really stands out in the notes here isn't just the lean operational model, it's where the technology is actually ending up.
Yeah, the application.
The caliber of the platforms relying on these components is staggering. We are not talking about consumer-grade routers here.
Definitely not.
Their proprietary tech is being integrated into the F-35, the F-A-18, and the F-22 fighter jets.
It is going into MH-47 and Apache helicopters.
Right. It is being utilized in United States Navy surface ships and even embedded inside Tomahawk missiles. The pedigree of that client list seems like the ultimate moat. Let's break that down even further.
Because understanding that moat is critical to understanding their valuation. In the defense and aerospace sector, switching costs and qualification processes dictate everything.
Right.
Think about the specific components they are providing. proprietary EMI filtering, which protects sensitive electronics against electromagnetic interference.
Alongside highly specialized radio frequency and millimeter wave parts.
Exactly.
And because of the environments those platforms operate in, the tolerance for failure is absolute zero. If you are piloting an F-35 stealth fighter or guiding a Tomahawk missile, you cannot have electromagnetic interference scrambling your targeting systems.
Or severing your communication uplinks, which means the barrier to entry is immense. For a company to get a single component approved for a premium platform like a nuclear submarine or a stealth jet, it requires years of rigorous testing.
We are talking about extreme temperature variations, severe shock, and vibration testing.
And exposure to intense electromagnetic pulses. It is a highly classified, heavily vetted qualification process.
Right.
But the brilliant part of this dynamic is that once a component is finally qualified and physically integrated into the architecture of a defense platform, the barriers for any competitor trying to displace them are practically insurmountable.
Prime defense contractors are not going to halt production on an Apache helicopter, redesign the avionics suite, and undergo another 3-year qualification process just to save a few pennies on a generic component.
They absolutely will not. The switching costs, both in developmental time and budget, are prohibitive.
Yeah.
Once a company like Mobix Labs achieves a design win and gets locked into a platform, they are generally secured for the multi-decade life cycle of that specific hardware.
And that industry validation is clearly compounding. They recently secured gold-tier supplier status with BAE Systems for the second consecutive year.
Which is a massive deal. BAE Systems is a giant prime contractor in the defense world.
So a gold-tier designation is a heavy signal of trust and reliability.
It reduces friction for future procurement, absolutely.
And management clearly recognizes the strength of this foundation because their expansion strategy has been relentless.
They are actively pursuing inorganic growth. We saw that strategy materialize in May 2024 when they acquired Rage Systems.
That was a strategic move to significantly bolster their wireless solutions.
And scale their high-reliability product lines, essentially allowing them to offer broader subsystem solutions rather than just isolated components.
Right.
But perhaps even more telling of their corporate mindset was the maneuver in September 2025.
Oh, yeah. When they launched a hostile tender offer, Pursuit of Peraso. Which is wild to think about. A 50-person team launching a hostile takeover.
It is bold.
For anyone who doesn't track corporate mergers closely, a hostile tender offer means they went directly to the target company's shareholders to try and buy them out.
Intentionally bypassing the target's board of directors.
That is a highly aggressive, shark-like maneuver, especially in the microcap tech space. How does a company that lean execute a hostile pursuit without overextending their operational bandwidth?
Well, it signals a management team that is highly confident in their ability to execute complex mergers and acquisitions.
Yeah.
And one that believes there is immediate synergy to be extracted by rolling up competitors. Peraso specializes in high-speed wireless technology, and going direct to shareholders shows a willingness to use sharp elbows to capture market share.
And more importantly, the broader financial ecosystem is willing to fund this aggression.
Exactly.
In January 2026, they priced a public offering for $6 million, and the crucial detail from that event is that the offering was oversubscribed.
Institutional money sees the vision.
They see the defense and aerospace expansion, they see the transition to larger military facilities, and they are lining up to provide the net proceeds for working capital and further M&A initiatives.
Right.
But that raises an immediate red flag for me. If they are securing vendor status with prime defense contractors and their components are in high-demand stealth jets, why do they need to price a relatively small $6 million public offering?
That's the real question.
If the narrative is so robust, why issue new shares for a comparatively modest sum of capital? We have to look at the whole picture here, looking at the flip side.
Right, looking at the flip side, it is crucial we step in as the voice of caution to deliver the lowdown on the risks involved here.
Yeah.
The fundamental reality is that cash flow timing in the defense sector can be brutal.
Procurement cycles are incredibly long.
And while the contracts are lucrative, the working capital required to scale production, build out new facilities, and aggressively pursue targets like Peraso requires immediate liquidity.
Which brings us to the first major risk, execution and dilution.
Exactly.
That $6 million public offering in January 2026 brought in vital growth capital, but it immediately dilutes the existing float. In the near term, that puts heavy pressure on their earnings per share.
which is a significant execution hurdle investors have to price into their models. Anytime you increase the outstanding share count, existing shareholders bear the immediate cost.
Right.
The management's bet is that the capital raised will fuel enough top-line revenue growth and M&A synergy to offset that dilution, but in the immediate term, it creates a drag on EPS.
Furthermore, digesting acquisitions like RAID systems while attempting to force consolidation with hostile offers requires flawless execution. If they stumble integrating these new technologies, that capital is wasted.
Which ties directly into the market sentiment and volatility surrounding the stock.
Yes, the news about the Gulfstream orders caused a bullish spike in early March. But tracking the broader sentiment context around that time shows a highly erratic chart.
Very erratic.
We have seen massive volume deviations where the stock experiences aggressive price swings. It behaves like a high beta asset, whipping around with significant volatility.
Yeah, the sentiment scoring from the broader market is essentially mildly bullish overall, anchored by the Gulfstream news, but surrounded by a lot of neutral, highly volatile trading sessions.
It is the definition of a high beta situation, meaning it is substantially more volatile than the broader market index. Algorithms and short-term traders are reacting to news flow, which creates those massive volume deviations.
But beyond the trading mechanics, we cannot ignore the broader market competition.
Wow.
We have established that their defense moat is deep, and the military is not swapping out radio frequency components on a whim. However, Mobix Labs is also deeply invested in the commercial 5G space.
And that broader semiconductor market is fiercely competitive. The military side is sticky, but the commercial side is an absolute battlefield.
You are dealing with massive telecom giants and global supply chains.
And that commercial 5G revenue strategy is highly dependent on macroeconomic factors and broader infrastructure rollouts.
Consider the current landscape. If inflation remains persistent or borrowing costs stay elevated, major telecom companies tend to slash their capital expenditures.
Right. If there are delays in building out 5G millimeter wave networks, whether due to high interest rates slowing down tower deployment or simply lingering supply chain bottlenecks, that could seriously throttle that side of their revenue strategy.
And if the 5G market cools down or faces infrastructure delays, they will have to rely even heavier on the defense segments to carry the financial weight.
It is a dual-pronged strategy, but one of those prongs is heavily exposed to harsh macroeconomic weather.
So investors are weighing the highly secure military contracts and aggressive M&A strategy against the realities of share dilution, high beta volatility, and 5G macroeconomic risks.
For you listening, how do you navigate this complex setup? Let's shift the focus to the 30 to 90-day radar. What are the tangible events and fundamental metrics we need to be watching right now?
The primary fundamental trigger on the horizon is their upcoming Q3 2026 earnings report, which, based on their fiscal calendar, should drop around May or June of 2026.
The dominant narrative driving the volume right now is all about these new production orders. The market gave them a premium for the Gulfstream announcement and the ongoing BAE Systems relationship.
Now, the metric every single institutional and retail investor will be scrutinizing is the actual revenue ramp.
They need to show the receipts.
Okay.
The news was the catalyst. The earnings report has to be the confirmation.
Are those Gulfstream and BAE orders successfully translating into tangible top-line revenue growth?
That's the key.
The consensus focus will be squarely on order follow-through. If they report an earnings beat driven by production scaling in the defense and aerospace segments, that validates the entire bullish thesis.
It proves they can handle the capacity.
But if the revenue lags despite the announcements of these orders, you will see that execution risk severely punished by the market. The tolerance for delayed revenue on a high beta stock is very low.
But earnings are not the only thing on the radar. There are also some compelling speculative catalysts floating around the periphery.
Yeah, back in February 2026, unconfirmed rumors began circulating regarding a drone-based infrastructure inspection platform.
This is a fascinating potential development. It remains unconfirmed, but if you map the rumor against their established high-reliability, wireless connectivity, and RF capabilities, it makes perfect technological sense.
The speculation suggests that if this drone platform achieves formal FAA certification and moves into actual field deployment, it could spark major new commercial partnerships.
The applications there are massive. Imagine drone fleets conducting automated commercial infrastructure inspections,
Scanning bridges, power grids, and telecommunication towers.
using military-grade, high-reliability connectivity to transmit massive amounts of data in real time. FAA certification for beyond visual line of sight operations is a massive moat in itself.
It really is.
If that rumor becomes a confirmed public relations announcement in the next few months, that opens up an entirely new revenue vertical outside of traditional defense or telecom.
Which leads perfectly into the macro tailwinds providing underlying support for the stock. While we discussed the macroeconomic risks to the commercial 5G rollout, the macro environment for defense and aerospace is remarkably strong right now.
We are witnessing a broader sector rotation into defense and specialized hard tech. This capital shift is being driven by ongoing geopolitical tensions and a massive global increase in defense spending and infrastructure modernization.
It's a rising tide that lifts companies equipped with high-reliability, military-grade components. Capital naturally seeks out sectors that are insulated from consumer spending downturns.
Governments do not stop buying Tomahawk missiles, upgrading their F-35 fleets, or modernizing their secure communications infrastructure just because consumer confidence dips or retail spending slows down.
That sector rotation provides a powerful underlying current of financial support for companies that have successfully navigated those brutal qualification processes we analyzed earlier.
Bringing it all together for the final lowdown wrap-up. Mobix Labs is an agile, aggressive player leveraging a fabless model to keep overhead low while maximizing output.
They are utilizing a highly sticky, qualified defense moat-spanning fighter jets, submarines, and Gulfstream aircraft to fuel their corporate expansion.
They have demonstrated institutional backing, they possess the operational audacity to launch hostile takeovers, and they are positioned in a macro environment that is pouring capital into defense and high-reliability technology.
However, you have to stomach the high beta volatility, carefully monitor the EPS dilution from their capital raises, and ensure their commercial 5G ambitions are not stalled by broader telecom capex slowdowns.
Which leaves you with a final lingering question to ponder as you watch their chart this week.
Can a lean, 50-person fabless company successfully juggle aggressively expanding its commercial 5G and drone infrastructure footprint while simultaneously fulfilling massive, highly classified military contracts without dropping the ball on execution?
That is the ultimate test of their management team, and the Q3 earnings will give us the first real clue. Thank you for tuning in to the Easy Money Show. Subscribe and hit the like button. Stay sharp, watch the numbers, and we will catch you on the next one.